The Fed just made a historic move with its eyes practically tied shut. No October jobs report, a federal government in shutdown mode. And somehow, they still chose to cut rates again. That's not caution. That's a leap off the ledge without checking if there's a landing pad. And if you think this is just another technical adjustment, you're missing the bigger picture. This is the kind of policy shift that quietly rewrites the rules of the entire financial system. Because while everyone on mainstream TV is still debating the soft landing, there's a second story unfolding, one they're not connecting. Japan is sitting on a financial time bomb that's been ticking for over a decade, and the pressure just jumped. When that explodes, it won't stay in Tokyo. It hits the US dollar, your tech stocks, your crypto positions, and the cost of living you'll face in 2026. So today, we're doing what CNBC won't, pulling these two crises onto the same table and showing you how they interact. Not to scare you, but to give you clarity in a moment when the people running the system are flying blind. The big problem. The truth is this: the Fed isn't just being aggressive. They're acting without the one thing they've always sworn they needed: data. Cutting rates with no jobs report is like a surgeon making the first incision without a monitor showing the patient's vitals. In 2008 and 2020, rate cuts were desperate reactions to a crisis already in full view. This time, they're stepping into the dark by choice. And when the institution that anchors the global financial system starts acting on guesswork, every ripple becomes a potential shockwave. But the second half of this crisis doesn't start in Washington. It starts in Tokyo. And you don't need a PhD to understand it. Picture this. For years, global investors basically borrowed money from the bank of mom and dad, Japan, at 0.1% interest, then parked it in the US, earning 4 to 5%. Easy profit, free money. This carry trade became the biggest arbitrage game in modern finance. Now imagine mom and dad suddenly hike the rate to something meaningful. Everyone who borrowed is sprinting to pay it back. That means they're unwinding positions in US stocks, treasuries, corporate debt, anything they can sell quickly. And that money doesn't slowly drip out. It exits like a fire drill. That's exactly what's happening as the Bank of Japan fights persistent inflation and starts giving up its zero-rate era. When Japan raises yields, global liquidity doesn't just shift. It snaps back, and the US markets feel it instantly. So you've got a Fed making decisions in the dark. At the exact same time, a major source of global liquidity is reversing direction. These aren't two separate stories. They're one shared pressure point. A global system suddenly losing its balance. And when the world's most powerful central bank is effectively blindfolded, while one of its biggest financial counterparts slams on the brakes, you don't get a soft landing. You get volatility. You get stress where no one expected it. And you get a market that punishes anyone who assumes things will work the way they always have. Direct impact. How the market reacts. When you put the Fed's blindfolded rate cut together with Japan's liquidity reversal, you get a market setup that splits cleanly into two possible paths. Think of it as a giant if-else statement for the global economy. One path driven by short-term panic, the other by medium-term opportunity. And the difference between winning and losing in 2026 comes down to which signals you watch and how fast you react when they show up. Scenario A: the short-term shockwave. If the money that flowed out of Japan for years suddenly rushes back home, U.S. markets get hit with a liquidity shock. Not a slow correction, more like someone pulling the plug out of the bathtub and watching everything swirl down fast. Risk assets get punished first. High-growth tech stocks with no earnings, over-leveraged crypto positions, and even treasury markets that normally feel safe. This isn't about fundamentals. It's about who has cash available and who doesn't. When liquidity disappears, the market starts stress testing every weak position, and anything that relies heavily on leverage gets wiped out. Bitcoin. It could easily retest the $50,000 to $55,000 range, not because the technology or long-term story changed, but because too many traders built positions on borrowed money. Scenario A is a classic liquidity test, and it punishes impatience. Scenario B, the medium-term opportunity. But if Scenario A is the flush, Scenario B is what happens after the pipes clear. Once the Fed sees stress in the Treasury market, and they've made it very clear in recent speeches that market functioning is their top priority, they will step in. Maybe they won't call it QE. Maybe the branding will sound softer. Liquidity provisioning, balance sheet adjustments, temporary operations. But functionally, it's the same thing. More dollars being made available to stabilize markets. At the same time, the forced unwinding in Scenario A shakes out weak hands and resets prices to levels that actually attract long-term buyers. That's when people with cash, the ones who didn't panic, start scaling in. Historically, this combination of aggressive policy support plus washed-out markets has created some of the best buying opportunities of the last 20 years. And assets that got slammed hardest, crypto, high-quality growth stocks, even certain bond ETFs, tend to rebound the strongest once liquidity returns. What to watch? If Scenario A starts, you'll see it quickly. The dollar spikes against the yen, volatility jumps, and volume dries up in risk assets. If Scenario B is forming, you'll hear it in the Fed's language first. They shift from inflation fight to market stability. That wording change matters. Both scenarios are part of the same story. A global system under pressure. One path tests you, the other rewards you. And the people who navigate it best aren't the ones trying to predict the future. They're the ones reading the signals before everyone else. Your 2026 action plan, from theory to reality. The next 12 to 18 months won't reward people who sit back and hope the system fixes itself. They'll reward the people who prepare. And preparation isn't about predicting the future. It's about tightening your foundations so that no matter which scenario plays out, you have leverage, optionality, and control. So let's turn all the big picture analysis into a tactical game plan you can actually execute. 1. Your most important weapon, personal liquidity. In a year like 2026, liquidity isn't just an emergency fund. It's your dry powder. It's your ability to move when everyone else is frozen. That means keeping a portion of your portfolio in cash or ultra short-term instruments like T-bills or money market funds. Think of it like carrying oxygen in a diving tank. When the market goes underwater, you can keep moving while everyone else runs out of air. Having dry powder doesn't mean you're scared. It means you're strategic. It allows you to take advantage of price dislocations instead of becoming a casualty of them. Even 10 to 20% of your portfolio sitting in safe, interest-earning vehicles gives you flexibility most investors don't have. 2. The watch list. 3 signals to track. If you want an edge, don't stare at 100 charts. Watch the 3 that actually matter. USD/JPY. If the dollar surges against the yen, it's a sign that global investors are unwinding the carry trade and money is rushing back to Japan. That's your early warning that scenario A, short-term shock, is unfolding. Fast movements here usually hit US tech stocks and crypto first. The VIX. This is the market's fear gauge. You don't need to memorize numbers, just recognize the pattern. If the VIX spikes and stays elevated, liquidity is tightening and volatility is spreading. That means be patient, not panicked. The 10-year Treasury yield. If yields rocket higher, liquidity is leaving risk assets. If yields fall sharply, it may mean the Fed is stepping in behind the scenes. Either way, it's a signal of where the pressure points are. You don't need to be a trader. You just need to be aware. These signals tell you when to act and when to wait. 3. The scale-in strategy. Your method for buying smart. When markets tumble, people make two mistakes: going all in too early or freezing up completely. The better path sits right in the middle, scaling in. Here's how it works. Take whatever amount you want to invest in a major index like the S&P 500, split it into 3 to 5 chunks, and deploy each chunk when the market drops another 5 to 7%. This removes the pressure of picking the exact bottom, because nobody can. It also trains your psychology. Instead of fearing red candles, you see them as scheduled entry points. This approach works especially well for assets like Bitcoin. If it drops to the $50,000 to $55,000 range during a liquidity flush, scaling in lets you build a position without gambling on one perfect moment. The key principle is simple. Stagger your entries, reduce your emotional load, and let volatility work for you instead of against you. 4. The long-term lens. Don't forget the big picture. Short-term chaos does not change long-term innovation. AI isn't reversing. Quantum computing isn't disappearing. Robotics, biotech automation, advanced chips. These trends keep moving even when markets panic. Corrections don't kill long-term megatrends. They reset them to better entry points. So as the market shakes out, the question becomes, what do you believe in for the next decade? Are you betting on AI infrastructure? Are you betting on renewable energy scaling? Are you betting on cryptographic networks becoming financial rails? When you have dry powder and a clear thesis, dips stop looking like threats and start looking like upgrades. 5. A quick note on real estate. Housing is splitting into two worlds. Luxury markets are softening because high-income buyers already fill their needs. But middle-class housing, starter homes, suburban homes, anything underbuilt, is still constrained by supply shortages. This isn't a market collapse scenario. It's a bifurcation. If you're young and renting, the play isn't rushing to buy. It's staying flexible while inventory opens up and rates settle. 6. Your 2026 mindset. Everything in this plan comes down to discipline. The discipline to hold liquidity. The discipline to wait for signals. The discipline to scale in instead of diving in. And the discipline to remember why you're investing in the first place. Panic is not a strategy. FOMO is not a strategy. Preparation is. This is the year where being calm, informed, and liquid puts you in the top 10% of decision makers. And that's the entire point of this playbook. Not to scare you, but to put you in a position of strength while everyone else reacts on emotion. The new mindset for a new era. At the end of the day, everything we've talked about comes down to one truth. The Fed isn't playing the old game anymore. They're making moves in a world where the rules are blurry, the signals are muddy, and the margin for error is shrinking. That creates real short-term risk, yes, but it also creates real opportunity for anyone who's prepared, disciplined, and paying attention. 2026 won't be a set it and forget it year. It's not a year where you throw money at the market and hope it all works out. It's a year that rewards clarity, liquidity, and the ability to stay calm when everyone else is losing their minds. Wealth won't flow to the loudest voice or the biggest risk taker. It'll flow to the person who can steady the wheel while the road gets rough. And that's the mindset shift this new era demands. You don't need to predict every twist. You just need to build the habits that keep you grounded. Holding dry powder, watching the right signals, scaling in with intention, and remembering the long game. When panic shows up, you stay patient. When opportunity appears, you move with purpose. If this breakdown helped you see the bigger picture and gave you a plan to navigate it, make sure to subscribe for more deep dives like this. Drop a comment with your strategy for 2026. I genuinely want to hear how you're approaching it. And if you know someone who needs this perspective, share the video with them. Thanks for spending your time here. Stay sharp, stay liquid, and stay ready. The next era is already unfolding.